in this week's Best in Class segment, we look at a top-performing bond fund. The $5 billion TCW Total Return Bond Fund invests in mortgage-backed securities and is up 15% in the last year. That is better than 96% of its peers. In the last 5 years, it has outperformed 99% of its peers. Bryan Whalen is a portfolio manager there. And Bryan, welcome. Thanks for joining us. And, a lot of questions here, but specifically, how did you manage to beat a majority of your peers with this bond fund?
Well, the fund was positioned about a year ago to capitalize on the distress in the mortgage-backed securities market. Back around the spring of 2009, it held close to 50% in distressed non-agency mortgages. And that sector's enjoyed about a 30% appreciation since that point in time. And we currently have about a 33% exposure to that sector right now.
Why did you go into non-agency?
Well, all the distress we've seen in the economy and specifically in the housing market, although we feel like we're still right in the middle of it, the securities market had been pricing it in quite some time ago. When you look at the prices that these bonds were trading at, you're looking at yields north of 10% with downside scenarios giving you cushions, even in a double dip type of situation, still with a positive yield.
So given what you're seeing in the housing market and the housing data, what does that tell you then about the mortgage-backed market?
Well, it depends what you want to look at. If you look at the securities market, it tells you what we already know, and that we still have a ways to go, particularly with foreclosures. Over 5 million homes still need to get distributed from weak hands to strong hands. But out in the with the average guy selling or only owning his home, there's still going to be some distress, and we're most likely going to have somewhere between a 5 to a 10% depreciation in housing before we bottom out.
Housing prices across the board.
Yeah, across the board nationally.
Bryan, agency debt, though, and we're talking about Fannie, Freddie, what would get you back into it? Or what would be attractive to you?
Well, to be honest with you, they're currently attractive. I mean, yes, they're all at all-time tights, but given what's going on with the housing market, there's a significant problem with regards to lack of equity in the homes, which means borrowers' traditional ability to refinance their mortgage has been extremely muted. So right now, agency mortgages are providing you about 300 basis points of carry over Treasury. So you're talking about yields of about 5% with very minimal credit risk.
Okay, so that could be quite attractive. Bryan, thanks so much for joining us. Appreciate it. Bryan Whalen of TCW.